Brian, thanks very much for doing this. I would really like to talk about the future of the global financial system. But before we get to the future part, let me just lay the groundwork. You have actually walked through the fire since the financial crisis. And I'm interested if you could identify 3 or 4 of the biggest challenges that you faced steering the bank from the time of the financial crisis to today.
Well, in our company, we had a little bit of a unique situation in that we went through the financial crisis, but it was on the backs of 6 acquisitions or so from 2004 to 2009 that were major acquisitions for the company, whether it was in the credit card business, the Northeastern banking business, the Countrywide, Merrill Lynch, et cetera. So you had all this acquisition activity, and then you had a financial crisis. And so we really needed to rescale the company for business reasons, which also fit into the goals of bringing the company's size, scale, scope, and business activity down. And so when we took over, when I took over in 2010, there was a very defined plan that said we were going to move out of these businesses and bring the scope of the company and raise the capital, raise liquidity, and really put the company to its core purposes, which is, we say it over and over again, we have 3 groups of customers: people, companies, and institutional investors, and we are here to serve them. And everything we have to do, every ounce of strength we have, every ounce of creativity, innovation, every dollar of capital, every dollar of liquidity has to support those customer bases, and everything else has to go. And it's a direct business. We deal directly with customers, not indirect. And when you got those principles, that really shaped the company very differently, very quickly. And that's probably the biggest changes we made. And there's a lot of specific pieces to that, but that was the change, to bring it into that clear focus, get away from the other stuff. And then by that, we made a lot of changes in capital and liquidity at the same time.
So in a sense, narrowing the scope and focusing on just a few segments, what were the most difficult kinds of decisions that you had to make? Or what were the things that were the toughest to do in order to get from A to B?
Well, we got rid of a lot of things that made money, were great investments, served markets that we don't serve. So if you think about it, it's always about that. And that's the toughest set of decisions, is even if a business is successful in a lot of people's determinations, you got to get out of it because you can't do it to have the greater good of the company go forward. The toughest decision is always about people. And you know, at the peak, we were probably 305,000 employees, and then we've reduced that down to about 240,000 through over many years, and it was in using attrition and all the things that you do. But the reality is that's the toughest job a CEO ever has, is to actually change the headcount in the company. But if you think about it from a sort of business purpose and what you teach in terms of business decision making, as opposed to the human being aspects of it, which are the most critical, you really get down to getting out of businesses that people have liked and thought about. So in the mortgage business, we got out of correspondent mortgage banking, i.e. buy and close mortgages from third parties. Our market share went from 20% down to about 4%, and we built it back up. That's not easy because there's a lot of people who believe in scale and believe in things which may or may not be there, but that's the way they were raised in the business. And to get them to understand that you're going to give up 15 points of market share for the safety and the soundness and long-term strength of the company, because in those businesses you weren't dealing directly with consumers, is a bit of a mind shift for people. I'd say the second thing was shifting from product to customer focus, especially in the consumer bank and even in the corporate and institutional bank. So investment banking and capital markets isn't a product. It is a relationship that we have with large companies that issue bonds and equity and do M&A, and we have to have a holistic relationship with them. And that was a big change, because a lot of you would express your view of my company as, how are you doing in investment banking fees, or how are you doing in mortgage market share or credit card market share? But a consumer isn't saying, I care about how you're doing in credit card market share. I'm a consumer. I have a relationship with you. How are you going to supply me a mortgage and my bank account and my credit card? Corporate customer, same thing. I need a line of credit, cash management, capital advice, whether it's M&A or whether it's equity or fixed income, strategic advice, whether it's M&A, capital structure advice. So that holistic customer-driven view really changed the company from a product view. And so that's probably the second major change. So scope activities and then product to customer. And the third was we had to completely deleverage the company. This is a company that was running probably 2.7 trillion in assets, and now runs at 2.1 trillion. So this isn't something, you hear a lot of people say, when these banks going to shrink. Impliedly, after Merrill, we were probably close to $3 trillion if you looked at us in summer 2008. the two companies before they're combined. We're at 2.1 trillion. The equity's gone from $60 to $70 billion of tangible common equity to 140 billion. Liquidity's gone from 100 billion to 400 billion. If you think about that, that's a massive deleveraging and change in the company's operating structure. So this isn't theoretical. It was $600–700 billion of assets that went away that, again, weren't core to the business, but it was hard decisions and took hard work because all of them earned money. And you could earn more money.
Right.
You know, these weren't assets that were damaged. These are just assets that weren't going to help the company be successful in the world going forward.
How, in terms of this reshaping and restructuring, focusing, how much did regulation, new regulation or evolving regulation, what kind of role did that play?
Well, it's more of a spirit of the law question because Dodd-Frank was passed in 2010 summer. The rules are just coming up now in 2013 into 14. We're still not done with what the Volcker, they're still implementing these rules. But we got out of proprietary trading in the markets business in 2011. I think it was second quarter, if I remember right. We got out of correspondent mortgage banking in the third quarter of 2011. So we were making decisions far in advance of these rules because what the rules are trying to achieve, which is express as higher capital and liquidity, which they do. They're also trying to achieve narrowness of the scope of the business to the core purpose that banks are supposed to do, which is facilitate the real economy. That's what we were doing. And by the way, it helped your capital levels, it helped your liquidity levels, it helped your shape your size to where everything is a core activity. So the rules are important, but we're already going down this path, and the rules are consistent with it because, frankly, I believe it's the right thing for our industry to do.
Because a lot of people would, the sort of popular view that major banks have resisted the regulatory thrust. And what I hear you saying is, actually, it's been quite parallel.
Right.
That of course, one can object to this detail or that, but in terms of the thrust of the regulatory effort, that's something you would have been doing anyway under the pressure of all of these acquisitions and the need to focus.
Well, so I'll give you a very concrete example. We had a private equity portfolio accumulated through all these companies. It was probably $60 billion in notional amount, on the balance sheet. It's down into single digits now and going to zero. And the reason why I believe that was the business purpose, which investors invest in the stock of Bank of America could also invest in private equity. They don't need us between the two. That was reversing a trend, which was all the banks had to do private equity investments with partnerships to get the business from the various firms that do it, or they had to do it directly so they could create more activity. And I said, we don't need to do that. We provide financing to the great private equity firms of the world. We provide deal advice. We provide liquidation. We take them back out to the market after they become private and been operated for numbers of years. We provide financing for growth companies, after they get the equity financing stuff. That's what we need to do. We don't need to have private equity. Now, the rules happen to say that if you have private equity, it's dollar for dollar capital. We decide the math, but it basically gets there. And the rules happen to say under Volcker what you can do in hedge funds or private equity funds. That was not around. It was the basic principle that investors can invest in private equity without us.
Right.
Were we adding value? And it freed up a bunch of capital. So if I had $60 billion in equity on my balance sheet, backed by $150 billion in notional capital, you're sort of saying, wait a second, isn't most of your capital going to support other people's businesses? And that's what we changed.
So let me ask you to look ahead now. And I know it's looking ahead. 6 months is eternity these days, but I'm going to maybe take a 5 to 10 year time horizon and recognize it's all somewhat speculative. But when you think about the future of the bank, not only in the U.S. but globally, what are some of the major forces that you think are going to be acting on your business, your portfolio of businesses, that you're going to have to respond to, or that's going to make banking look somewhat different down the road than it does now? When you think about the really big forces you're going to have to deal with one way or the other?
Well, I think you can look at them overall, but you can also look at them by broad customer capabilities. So if you look at it, start with the markets business. You've had everything in market. Technology is a number one driver. Information, and it's not what people think of as trading speed. That is one part of it, but really it's information. One of the things that the street firms used to have is information that they gave to clients. The clients now can access a lot of that information directly. So, what it means to have a research team is completely different in a world where technology keeps moving, people's capabilities to access all this information, and importantly, decipher it. and have it.
Right.
Yeah, because if it was just raw data, it would overwhelm everybody. So if I run a big asset management firm, which is one of our big clients, and I have a research capability in the firm, and we spend $900 million on research in our markets business a year to give to our corporate clients and our investing clients to help them understand ideas. You know, the nature of that keeps shifting, because what it used to be, 10, 15 years ago was a lot about just getting financials and multiples and things like that. Now it's come to really long-term trends, because all the other stuff has been commoditized by technology, going back to Bloomberg and S&P and all the different providers. That is a massive change. So where it goes next is there'll be continued commoditization of stuff that you can find and analyze and bring the algorithms to the practice, coupled with continued technology invasion into the core trading platforms. Look at what happened to the New York Stock Exchange over the years and the equity business, come to the fixed income business. But the real question is, what won't go away is the need to have value-added advice and the ability to understand all that and figure out how to fit it into the client's needs. So
it's real intellectual capital that you're talking about, right?
But technology is going to change how you can deliver it, why you can deliver it. So that's the number one issue. The second issue is globalization. In the end of the day, in the markets business, you cannot be in the business without having a platform to support an investor in New York, or investor in Boston, or investor in Chicago, or investor in Los Angeles, or wherever they are. You have to know the Brazilian markets and stocks and be able to execute and understand them for them, because they are global investors. So the reason why outside the United States we have two businesses for the large companies, corporate investment banking, and large investors, is because they're global companies. And the same company in London needs to know all the markets in the world. So you have to be a competent competitor, and we are, and we will be. You got to be global, which means you have to be willing to research all the different markets. So we're one of the top research firms in Japan, for example. We're one of the top research firms in Latin America and in the United States, because you can't look down. So globalization, technology are the two major issues in the markets business. When it comes to the companies, it's the same themes, in the sense that the ability to do cash management today versus what it was years ago is just so different. So you can take an iPad. We show a restaurant called Boca Restaurants in our ads. The NFL is riding around paying bills on his iPad as he's moving between the 5 or 6 restaurants he had. I mean, that distributed computing power changes everything. And so the cash management capabilities. And by the way, you can execute FX. So if you were buying goods from Asia and you wanted to hedge the currency risk embedded in that, or require the currency to do it, you could do that. So the ability to technology, again, is huge. And then globalization, that market's a little bit different. Middle-sized companies now are competing in the world, and you got to be able to provide the advice and the stability for them to be able to do that when they don't have the staff that a big company does. Then when you get the larger companies, the global companies, again, technology, globalization are the major trends. So when you get in the sort of institutional side of the house, I see those are two big trends I see. And it's going to come at people differently. They think it's not, trading speed was critical. Risk management, organization of data and analysis is critical. Big data, as they talk about, critical. But the reality is what really is going to do is a lot of the, any task that can be attacked by technology to make routine, from spreading a financial statement to analyzing it to figuring out, is going to just be after, people are going to be after that with technology. And that's true across. We'll talk about the consumer side differently, but let's stop there, because the institutional side has similarities. Consumers really has some different elements.
Okay, we'll come to consumers, but in light of what you're saying about technology and globalization, can you speculate how will the bank look and feel differently a decade from now? I mean, recognizing these trends, what is the implication for the structure of the bank, or the management of the bank, or the bank's ability to be at the cutting edge of competitiveness?
Well, I think as you look at our expense base, which we've been bringing down for all the sort of legacy expenses and getting out the mortgage stuff, which is different. What we have preserved is we invest $3.5 billion in technology development a year. That's pure development. And I don't see that changing. So in the markets business, $800-900 million, and the commercial business is a similar amount. So in the investment technology and risk management. So when you think in the future, it'll be the benefits of that technology. Now, do I know what program or capability we're deploying in 2024? I don't know exactly, but I know that we'll spend between now and 2024 $30-odd billion in technology development or more to figure out what the right programs are and put them in place, the right stuff. And so that is a huge trend. So I think it'd be naive to say I could see that. I can understand the trends and we can invest against it. We have lots of smart people figure it out. And you wouldn't have said 5 years ago what we had today, But it's that what changed in financial services, that pace, because the technology is changing dramatically. When I started in this thing, you could not change the business that fast. People used to come into me, and when I first became a head of strategy in 1994, technology is going to destroy everything. It's taken 20 years to what they thought would happen in the next 3 years. It'll be a little slower, a little bit, but the kind of technology now is actually moving at an accelerating pace. So it's always been technology issue. The reality is it's here in front of us, and the amount of money we spend on it. So what do? We preserve the money. So I don't know exactly what will work, right, but I know that we'll have the money and the smart people to figure it out, and we'll have a relentless attitude around innovation. So that what I do know is we'll be serving large companies and large investors. What I don't know
you're
is
describing almost the R&D, the bank being in part an R&D lab where you are investing in technology in a way that would have been inconceivable 10 years ago.
We're probably 150% of the rate we were 4 or 5 years ago already. And it's across all dimensions. It's across big data, as people call it, which is not my favorite term, but data analysis and algorithms to process. But it's also across taking routine tasks and moving them. And so in routine tasks to a trader. The risk management integration now is, you sat and traded and I had to sit beside you to watch it, right? Because I physically had to be beside you. Now I can be watching that trader in all the different ways, from the trades they're doing to who they're talking to, what they're saying, through technology. Yeah. It changes the nature. So a risk manager can be pulled out a little bit in really doing different types of work. And so what I know is 10 years from now we'll be a global corporate investment bank, and we'll be a global markets player of high order. But I think the business will keep ebbing flowing. And even in investment banking, we only have as many bankers as, I think, we have about half as many investment bankers, maybe 60%, as we did at the time of the merger of Bank of America Merrill Lynch, and we're busting through record revenues. Okay. So the leverage even in a banker's time is huge because of the technology and the capability.
And how about, I realize that technology and globalization are not separable, but just as a global institution, in addition to the technology, with emerging markets, let's say, growing so fast, and with a global middle class, and with all of the infrastructure, all of which you're going to want to participate in, will the bank look, or could the bank look different a decade from now, just in terms of its global footprint?
No, I don't see us. We were in the wealth management business internationally, and we got out of it because it wasn't a business that you could actually. We sold to somebody, took back an interesting company in Julius Baer, and they're going to do a great job, but we didn't have the scale. And so the issue is consumer banking. It's not clear what, other than a brand that's great, in a technology, it's not clear what we would bring to consumer banking in other parts of the world that is not already there. Okay. When you look at, but the difference is what we bring in global corporate investment banking, the kinds of people we have, the information backing, the research backing, is completely different scale than a bank than an indigenous bank in, say, Italy can provide. And I think that's why we're competitive. And that's why I think the structured industry will be these global corporate investment banks and markets banks around that narrow group of 2,000 or so big clients of the world, and 1,000 or so investors. That's where we'll be playing. I don't see us being a retail bank or a global wealth management bank in the next decade, because frankly, there's just too much opportunity in the business we're talking about. Right. And global corporate investment banking markets outside the United States that we still haven't materialized on. And by the way, there's so much opportunity inside the United States with a #1 wealth management brand and #1 consumer bank that we can grow this a lot without having to worry about whether we're hitting a growth curve. Even in the big, slow growth, big, monolithic economy that everybody thinks about in the U.S., there's so much opportunity for our company on the personal side of the business.
When you think about the competition, I'm thinking globally again, and let's stay at that very top level. How are the major financial institutions going to differentiate themselves? Or put it another way, when you think about competing, with the Citis of the world or the Goldmans, where a lot of people are chasing the same kind of business. So where do you see the major point of differentiation?
Well, I think it's the people and how you deploy the people in terms of technology and the backing up of the intellectual property, the research and other things. That's what it comes down to. In the high-end businesses, it is all about the talent you have, talking to the clients. Now, how you can make them more effective is tremendously valuable. That's one thing. So it's always about the people. The second is I believe the winning model has to be an integrated universal banking model, so-called, which is both corporate banking and investment banking and markets. You can't make this being a sole provider. So we need to be able to lend money, do cash management, and do capital markets transactions. And then because we have the capital markets transactions, we can move them through the investor side of our house because we're the link between the issuers and the investors. And then we can provide, that then provides, the research we provide to both sides of the house provides scale and capability. So I think, there'll be a limited number of banks that can actually afford to do that because there's a limited amount of revenue, honestly, in the world in these businesses. They're big size revenue, but now you're covering up the world, not a country. And so I think those people who can have the people and the technology and the capital and the risk management are the ones that are going to be able to compete because it's obvious if you're going to do it, you're going to have to put up more capital by the different rules and everything. So you got to be able to get a return on that, and that's for scale and capability.
Now, we've been talking so far about the bank and its positioning. Yeah. If I used a different lens and I talked about sort of the global financial system, right. The rules, the way decisions are made, the issues of exchange rate, capital flows. Right. Do you spend any time thinking about the structure of the global financial system that in the sense that what you would like to see, right. What would not impede your ambition, that would not impede your business, or in a sense, is that just a given? Well,
no. I think about it as what would be good for the world and how we do. We need a capital markets in the various regions or countries around the world against economies of size that is as liquid and deep as the United States. We need to, what a lot of people think of that is that's a sort of what I call front-end problem from the issuer side. It's actually an investor issue, which you need the private pools of capital pulled together so the big investors can be there to buy the equities and fixed income and everything and pass through a variable price to their customer, through the asset management valuations and stuff. The reason why you need that is that's a great shock absorber. That takes all the risk in the markets and spreads it out to the broadest group possible. It allows you to raise capital very quickly by having investors come to the table. That is not the condition in equities in a lot of markets and clearly in fixed income in a lot of markets. As a matter of fact, we found out that the fixed income markets in the United States weren't as deep and liquid as we saw it across asset classes, across variations of asset class. We got to get to those things. That is very difficult because the investor pooling requires a whole thought process around, even in the EU where there's been rules allowed to happen. It's still not there because of mutual funds that can operate multi-jurisdictional and bring in assets very easily across it. It's capital flight issues. If I'm a Brazilian citizen or an Argentine citizen or other Latin American countries investing in mutual funds which are global, how do I know that the savings comes back to my country and invest in my country, right? If I take my public pension fund and convert it to private and then invest globally, or I take it even public and invest it globally, which countries struggle with, it can't support my local economy. So there has to be this sort of, frankly, a big leap to where you say, you know what, we're just going to let the market bear and let real capital markets. To me, that's the most critical thing. That cures a lot of what we've seen. What it does in markets, especially outside the United States, and you compare and contrast, is the capital markets allow the bank balance sheets to come in shorter duration. Between insurance company and pension and other investors, they invest long duration. That then leaves the mark-to-market cycle and all the debate we get into shorter. The size of risk taken by a bank can be more easily distributed. So you don't hold $1 billion loan position to somebody. You hold $25 or $50 million, and the rest has been distributed to the market. So that is really the number one thing. If we can get that, then I think the capital can be raised easily to support the growth in developing countries, to bring the buffers in developed countries. But that is a lot of work. And if I said, an impact that we as an industry should have on the world is how do we do that over the next decade or so fairly and using all the advantage of technology and stuff to help it develop. But it's going to take a lot of policy support for it because the near term has been for people to go their own corners and sort of put a ring fence around their country and say, my capital, my people, my banking system, my regulation. And that's not going to work when I'm saying you had to have global capital flows. And that it goes against the monetary policy issues and all the things you'd be well schooled in. But if we don't do that, what we're going to have is country by country issues that they're going to ask capital to come in and solve, that capital really can't come in and solve on a fully liquid basis. Therefore, it gets expensive. Therefore, and you can't. And the bank balance sheets are going to build up because they have to support the real economy. And they're going to be multiples of GDP as opposed to the United States. Even the big banks, with all the consolidation, are still about 0.6 of GDP added together. And other countries are 3, 4, 5 times GDP. That's because the capital markets are here. And that's what, to me, that's the biggest need for the world, is to get a capital markets structure on a worldwide basis.
So what I hear you really saying is that for the bank, but also for the world, a more integrated capital market, a more liquid and mobile capital market that is less national regulations. And I assume that with all that would go more harmonized global regulation, so that you're not subjected to different.
And it also provide conversion of savings to more private buckets away from state attributes, which can change the nature of how those savings are put to work and market discipline and stuff. But by the way, there's a lot of policy decisions people have to make in between.
No, you're painting a picture, but that's what I asked. What kind of what would you like to see?
Yeah.
So let me end with 2 questions. One is, and I'll give you both of them. One is when you look ahead the next 5 to 10 years, what worries you the most? And the second is, what makes you the most optimistic?
Well, we didn't talk about the consumer banking before.
Yeah, okay. Bring that in, please.
That's what worries me the most. So I can tie it in, and then I'll talk about other stuff. So obviously worries, just to go down a list of worries you have, which is, the exit of QE, which is on people's minds. If you look at, the emerging markets, how the impact on that, the constant need to figure out how to have the imbalances around the world sort of mitigate. All those things are critical issues. But one I worry about a lot is in our industry, for the first time, and maybe forever, and everybody says this is different this time and all that stuff, but the reality really is that you've untethered geography and physicality from the service and product across the consumer franchise. That is mind-bending in terms of what it happens. And so,
can you explain that?
So because the computing power you can carry around allows you to carry a bank in your pocket.
Right. Okay.
And that's a very simple concept, but it's very life-changing. So we have 8 million customer visits to our branches every week. It's stupendous. Any retailer would give their right arm to get that much traffic. We have 40 million people that engage on us on mobile phones in a week, online in a week, and I think 23 in mobile phones. So 60 million numbers versus.
It's a mind-boggling number.
Right. And so, but think about that. But the mobile deposits now are about 9% of all the deposits of checks in our company. You couldn't do it until the summer of 2012, to the third quarter of 2012. So that's not very long. The mobile phones, mobile capabilities, iPad mobile, untethered capabilities, has done what it took 25 years for the ATM to do in terms of transaction volume in 5 years. So what's happened is you've untethered this dimension, which was never untethered before, which is now you can think, I can serve you, in a way that we never served you, which is, and think about it over all the different kind of, for a person's earning median income, we send out people in our retail customer base, which is sort of median income American, and we have a preferred customer base, which is mass affluent. In those 2 customer bases, we send out 20 million texts a month telling people their balances are low. So effectively, we are reminding them to keep their checkbook in balance, right? And we want them to avoid the overdraft fees. We don't want them to pay them because it's not a great experience. So we're trying to help them avoid it if they can. And so you have that type of activity. You have the personal nature of it, the distributed nature of it, the fact that even on our low and moderate income customers, 2/3 have a smartphone today, and that will become more over time. It's much better than have to go in a physical branch with all different attributes. It allows them real time. The safety and security of the authentication and payment can be done differently. I can say, geez, are you really here doing this? And you can ping back and say, yes, I am, and I can then let the transaction go through, real time texting. And by the way, the customer belief that that's okay. If your bank was calling you to say, the transaction's coming through and do it, you would get really upset. If a text came through and said, is this you and is this your transaction? Oh, yeah, yes, and you're done, right? All that is just tremendously different. And so the consumer side in our company and the investment management, wealth management side are stellar businesses and performing well. But the technology worries me over the next 10 years because the first time people can attack our natural advantages, which is 5,000 plus branches, 16,000 ATMs, all that installed base that you have. So we have to attack ourselves. And we think by other people's benchmarks, we might be 1.5 to 2 times more electronic activity on average on a given month than our biggest peer competitors because we've been driving our customer base that, but still 8 million come in and we serve them well too. And so it's that You want to do both, and that to me is what worries me. If you mess that up, you could actually lose a franchise. I don't think my predecessors, 230 years since the first part of our company was started, had to worry that if they were on the corners in that was a Massachusetts bank in Boston, Massachusetts, if they were there, they'd probably get business because they were there where the population was. Now we could lose that franchise. And so it's very different. So the technology threat to the business is wholly different. Before you get into Bitcoin and all those other things, technology threat to the core business. So you worry about that. You worry about the ability to manage the complexity of the place, and that's why we keep sizing it down. You worry about the ability to make sure you really have smart people who can understand the risk in all these countries you're operating, how to ebb and flow. And by that, you also keep your activities limited. So I don't have the kind of risk to an economy that's hard to figure out at a level that I can't be comfortable. We can get in and, we can back out of our commitments, not that we won't fulfill them, but we can lessen our commitments over time. So you worry about the world and making sure you understand all economies. But this technology impact is really just different this time. And by the way, you can take that and I can play that through all the different businesses, all different things. But if you just start from that basic principle, you're carrying a branch in your pocket. I used to have to build one, or I used to have to do it. That is a wholly different pattern. So somebody else can get to that branch without having to build the branches, and that's a big difference.
And in terms of your optimism, when you think ahead the next 5 or 10 years, what makes you feel, aside from all the hard work you're doing and the great talent you've assembled, from sort of a global and technological standpoint, what makes you the most optimistic that banking will be able to really enhance the real economy and the lives of people in a way that maybe the public doesn't see right now?
Well, the issue is they do see it. And the question is we got to make that what people think about us first as opposed to all the other stuff. And that's just by living our purpose. So our purpose at Bank of America is to help our customers, clients live their financial lives. It's their financial lives through the power of every connection, which is connecting together as franchise. And so what we can help people do differently than we ever could before is they can have a great checking account with us, with a great credit card capability, a great auto loan, a great mortgage loan, a great investment relationship with the #1 brand. So we've arrayed in the consumer business and likewise in the corporate and markets business the top 1 or 2, 3 capabilities in all our businesses. That's what gets me really excited because I can integrate them in a way the customers haven't really found out because they were all over the place through the history of what happened. But I also can do it and probably give the customer more services for less cost. And if we think of that as our purpose, that is facilitating the real economy because at the end of the day, people spend X on financial services and if they can spend a little bit less than X in the core American consumer context, they'll spend it somewhere else, and that's good for them, right? And so the efficiencies in scale and technology and all that stuff, we can pass through them. When we get to the middle market companies, the rate a middle market company pays relative to what they had to pay many years ago is unbelievable in terms of credit availability. That's because the capital markets provide the efficient capital, liquid capital, and so we can pass it through the market and do it, and we can get access to capital markets. So those are what make me optimistic. If we stick to our core purpose and build our products and capabilities around directly serving those customers and helping them live their lives through connecting together the capabilities, that is a wonderful time to be running a marvelous company like ours because you just sit and do it and do it. We aren't making any acquisitions. Don't have to distract ourselves doing that. We think we've got the rules figured out. They always change, but we think we got that figured out. There's very complex technology issues, but we're spending a lot, so shame on us if we don't pick the right ways to do it. There's new entrants. We're learning a lot about them. They're learning from us. We're partnering with them. We'll figure that out. That's very optimistic because it's all concentrated on those good things as opposed to having to get through the mortgage crisis in a way that gave dignity to people who were struggling with their homes, to get through the financial crisis and get their capital and liquidity. So that's what makes you optimistic. And that simple purpose, living that's what we're here for.
And just finally, are you broadly optimistic that from an economic policy standpoint or from an economic conditions standpoint, that the world will come out of the slow growth period that seems to have ensued from the financial crisis for a long time? And that, these problems that you hear about all the time, mass underemployment, huge problems around the world in terms of youth unemployment, inequality. I know that that's something that you focus on. That somehow, the growth cycle is going to return. I think you're saying it doesn't necessarily have to, for the bank to succeed, but just as someone who's running a major institution and is in touch with so many different sources of information and so many people around the world, are you fundamentally optimistic in terms of the economic, let's say, the long-term economic trends?
Well, yes, because at the end of the day, you have billions of people out there that are intelligent and trying to make their way in the world, and you see the talent in some of what we call emerging countries in terms of, we have a program where we're bringing kids from African universities to work in London. Last year we did 9, this year we did 23. Just smart as anything and figured out. So the talent, educational availabilities, for really talented kids across the world are there, and they'll go solve problems. The technology will solve problems that heretofore were hard to solve. But there is a core issue out there, which is, we talk about an a financial crisis, but the reality is we've been in a Western developed economic crisis for many years, where the migration of labor has, of manufacturing and labor has moved to other countries through competitive forces. And that has been hard for us to adjust to, and the leverage covered it up. Well, now if you take the leverage and keep it out of the system, we've got to cover it through good core activity. That's where the only way you can reconcile that is you got to believe in innovation. Now, the problem with innovation in the short term, it's actually holding, it's disintermediating employment levels. In the long term, it'll create some sort of jobs and something. And that's what we got to think about, is we've got to have that faith in innovation and across the whole world and drive it. It is going to be slower than people want for a while, because we are absorbing huge amounts of people, in terms of moving into, that we expected to keep going like this, that maybe just core growth rate's a little less, but it's going forward. And so in the United States, we have a 3% GDP prediction for 2014. We have 3.6 for the world. Those are not growth rates that people would say, oh my gosh, let's run home. But 3% in an economy size United States is a lot of economic activity, but there's still dislocations in employment. In the meeting with the White House last week, you talk about long-term unemployment. The International Business Council talk about youth employment. The theme is, how do we train people for the jobs of the future? And in the near term, how do we actually take people and get them redeployed and help match a skill set? And that's going to take some work. But long-term, what we build as a bridge is we have to be more aggressive using technology to help solve these problems, and that's what makes you optimistic. It is a slower growth environment for a while, not because of the financial crisis. That actually probably covered up, because you're having a worldwide change in terms of labor availability and labor access and labor capability that has been going on for 30 years or so, that we got to then figure out it's been wonderful in terms of what you can buy for a price. The question is, what was the downside? Yeah. And then we're still dealing with that. And our job as a participant and as a bank is to help figure out how to make that happen. Is it financing new educational techniques? Is it the philanthropic work we do on talent development? Is how we hire. We signed on the commitments to hire more long-term unemployed, and we'll get that done. Hire in military. We got to do our part as an employer and as a company, but society has to figure this out. And I think it's a difficult case, and it will take real long-term thinking here. And I'm encouraged, because they actually we all recognize the issue, but we got some work to do to get it done.
Brian, thank you very much.
Thank you.
Really interesting discussion.
Thank you. Thank you for being here.